Should you lock in your variable rate mortgage? Hey everybody, my name is Ryan and I'm Koukun. And in today's video, we're going to be discussing about why I decided to lock in my variable rate mortgage into a fixed rate.
So, right, you have a variable rate mortgage on one of your rental properties, and recently you went through the sort of thought process of should you lock it in, and why don't you share, how that went, and what were some of the decisions you sort of thought?
For sure, yeah. So, like you mentioned, got a variable rate mortgage, and important to distinguish that it is a variable rate with a variable payment. So as rates went up, my payment also went up. So I was still paying that principal, but it was really making that cash flow, significantly negative, right? So, kind of obviously there's been a growing kind of spread between the variable rate and fixed rate that you can get. Also kind of got to a point where we just got past 3 years left on the mortgage. So from a renewal perspective, if you want to lock into a fixed rate, it's got to be without penalty anyways, it has to be longer than your existing term. So the fact that it's went down to 3 years makes things a little bit kind of more manageable to lock in for. Right now between the rate that we're looking to get and the rate that we're currently at, we've got a 1.5% difference, which is pretty substantial and affects our mortgage payment by about $400 a month, a little bit more than that actually. Okay. So that takes a property that's in the hole and gets it to very close to not being in the hole.
Yeah.
Which is a pretty big factor, right? So
I think you mentioned a few things that are important. One of which is you need to have less on the term than the term you're trying to lock in for.
yes.
So you were under 3 years and you were able to lock into a 3-year term. You can't necessarily just get a new 5-year variable rate mortgage and then switch to a 3-year fix.
Correct, right? Yeah, I've got one that's another variable that's just over 4 years.
Yeah.
And so if I wanted to do that one, because it's just over 4 years, I'd actually have to lock in for LFI, which that didn't make sense to me.
Yeah. And the other point was when you switch from a variable rate mortgage to a fixed rate mortgage, by staying with the same lender, calling up their renewal department, asking for, hey, what's the best rate you can get for that fixed term? You don't have to pay the typical 3-month interest penalty.
Correct.
That you would pay if you broke the mortgage and sort of switched lenders.
Yeah. So very different than going back to a broker or trying to go, rate shop from different lenders. This is just basically calling my existing lender, even though we got the mortgage through a broker.
Yeah.
We're now just calling the lender directly and basically saying, hey, we're currently at a variable rate. We'd like to lock in for 3 years.
Yeah.
What kind of terms can you get us, right? So, obviously sometimes you have to kind of push back with them a little bit. They'll give you the first rate and see what you take. And sometimes if you can push back a little bit, sometimes they'll be willing to give you a little bit more, which can also make that spread a little bit more and makes it more meaningful to kind of make the jump as well, right? So
you had to make a few decisions, right? So like you said, the spread was about 1.5%.
Yeah.
And you were going for a 3-year term. How did you decide whether this was worth it for you? Because everyone's talking about rates coming down. What was sort of the math you did head to?
Yeah, so there was a few factors, right? The first factor that we considered was our selling and selling incomes.
Okay.
Because obviously there's a bit of some minutiae and kind of finite details there that we can get into, but basically, generally if you're on a variable rate mortgage, you're paying 3 months interest. If you're on a fixed mortgage, there can be a little bit, it's not quite as simple as that. Sure. So if we were planning on selling it in the near term, it may have not made the most sense to do that. Now, with this property, the plan is not to sell it in the next, 2 to 3 years. So that was the first thing that we're like, okay, you can kind of set that side on it.
Yeah.
And then the big factor is obviously, at the end of the day, we're doing this to, save or make money.
Yes.
Right. So does it make sense to lock in for 3 years at a rate now?
Yeah.
Or to kind of ride this wave? Because as, in your industry and in my industry, we both know, everybody's talking the rates go down.
Yes.
Right. So that was a bit of a factor that we had to kind of consider and run our numbers on. So few things that kind of talked about with you as well as some other kind of industry professionals and my partners about it to kind of see what made the most sense. Because if we can save 1.5% over 3 years, but rates are going to go down 5%, doesn't necessarily make sense.
Sure.
Now, I don't think that they're going to go down 5%.
And that would be zero. If that's fine.
So they were there. They were there. But I don't think they're going to go back to that. And I think that's a pretty safe assumption. Whether they get to that 1.5% or maybe even go a little bit below that 1.5%.
Yeah.
I don't think that's unrealistic to think about that at all. That being said, there's a little bit of safety and security kind of just going for now. And in order for me to lose money from this decision, basically we'd have to see a 1.5% drop in like the next year and a half.
Yep.
And then we'd have to see almost another 1.5% drop in the following year and a half.
Yep.
And so when I start to look at both of those things and like the likelihood of that happening,
And that's just a break even.
that exactly, that's so like, I was
This is have to be deeper cuts than that in order for you to have like a opportunity cost from going this way.
exactly. So we're talking in the neighborhood of 13 plus rate cuts at 25 basis points of rate cut. Over the next 3 years.
Yeah.
Which to me seemed very likely. It does to me seem likely that I think, we'll probably get that 1.5% at some point between now and the next 3 years. But is it going to go to a point that's going to actually create an opportunity cost for me?
Yeah.
It's possible, but I don't think it's highly probable.
Yeah.
And moreover, even if it was say like a 50-50 chance, where like 50% of the time I'm going to either make or come out ahead on this, and the other 50% of the time, again, we're not talking losing tens of thousands here. It's a very small opportunity cost, but I get the peace of mind of locking in now, and I get take a property that goes from being in the hole to being like break even. And there's a huge psychological factor on that, because I think anytime, as I'm sure you know, and maybe some of our viewers know, that when you're holding a property that's routinely negative, and I'm not talking negative by like $20 or a cup of coffee a month, like hundreds of dollars a month. Your mindset around that property changes. You start thinking, how do I get out of this? And if you already have market rents and you can't re-am or do anything like that, and you're at some point in time, you're going to probably want to sell sooner than maybe you should. Right? Because obviously,
And any expense is an emergency. A furnace repair, anything, it's like, oh, money coming out of my pocket to pay.
Right. Yeah, it's huge. You're not only losing money every month paying into it, when something does come up, which invariably they always do.
That property,
We had some nice stuff come up recently. We had to repair the sewer line out front because the tree root had damaged the main sewer line. So quick $10,000 bill there, and any reserves that you may have had are kind of depleted, and now everything's just starting to come out of your pocket more and more. And the psychology of holding a property that, whether it is or it isn't, feels like a money pit. It's going to cause you to make different decisions than if it doesn't. Right? So that, I think, is a big factor into this. One of the reasons, like I mentioned in the beginning, we were planning on selling this because it's not a good time to sell. A tenant, especially a property. Like if you're selling a regular single family home, I think that's done a lot better rebounding recently than your tenant occupied properties. Your tenant occupied properties, I think, are still very, very depressed and haven't seen the rebound we've seen in the single family. And so by that sentiment alone, it doesn't make sense to sell this property anytime soon. And likely there's going to be a little while before it even catches back up to the single family, let alone get back into, what it was
a premium because of the work you've done to make a legal basement apartment. Like you should be paid a premium for it. We're not seeing that right now.
You're almost seeing the opposite. Like it's kind of funny. Like if you look at a duplex, that's, you say a legal duplex that's right beside, same home, cookie cutter subdivision, that just has a basement rec room. That basement rec room is probably actually going to go for more than that legal duplex rec. Which is crazy when you think about material costs alone, functional use of it, the highest and best usable property, everything that kind of goes towards what creates value in real estate. Doesn't make sense to me about that.
It is a strange scenario. Now, you mentioned you have a mortgage that is a variable rate mortgage where the payments have gone up. So most of the people watching that's probably Scotiabank and a few other lenders.
Ours is Scotia, but there are a few other lenders who do the variable rate payment.
So what if an investor has a fixed payment but a variable rate mortgage? Is this something to consider?
So I think it could definitely be something to consider. But one thing that I would really caution you on, similar to that point we just made, is the psychology of the lower. Because in that scenario, your payment may go up. So your payment may go up. You may start losing a little, like say, let's arbitrarily, your payment goes up $400 a month. But now you're adding $700 in principal paid up. From a math perspective, that actually does make sense. Okay, that's a purely financial
in your pocket.
It's more
when you sell the property.
When I sell the property down the road, I'm whatever that interest rate is, I'm literally making that out of that extra.
Yeah.
Right. So from a pure financial perspective, that makes sense. The one thing to consider there is the effect it's going to have on your psychology or psychologically, I should say. Yeah. Because if you take a property that maybe with your current payment is break even, and then you need to up it to make that $400 extra, now that's coming out of your pocket every month.
Yeah.
That's not going to likely, unless you're doing extremely well and $400 coffee to you, it's going to probably make you start thinking about cycling. And as we just mentioned, I don't think selling a tenant occupied property in this current climate is going to be the best of it. So going through this process basically is going to be like, hey, yeah, it's good from financially, but that's going to make you sell a property a year or two earlier or 5 or 10 years earlier. It's probably not actually a good move for me. Yeah. And so some of that is kind of looking into yourself as well. And if you've never had a property that's negative cash flow, like hundreds of dollars every month, and you're like, oh, it's not going to be that big of a deal.
Yeah.
Talk to somebody who has had a property that's lost that much money a month and see how it's affected. And again, everybody's going to be different. Everybody's going to have a different risk tolerance. Everybody has a different amount disposable income at the end of every day, right? And if you got $10,000 disposable income, maybe that 400 isn't a big deal. But if you've got 4,000, maybe that 400 is a big deal. Or better yet, it's 1,000 or something like that, right? So I think it really is a personal decision for you, and it's not purely financial. Obviously, you're making investments to create good financial decisions, and that's what we're doing. But sometimes the immediate financial decision that makes sense financially will actually hurt you long-term financially, right? And so don't cut off your nose to spite your face kind of thing, right? And it's an age-old adage, and I mean that's kind of something important to think as well. So
like in just these last 2 years, one of the realizations I had on the investing side was to invest for the long term, to get the long-term return. It's not just about the amount of time you stay invested, it's can you stay invested during the tough times?
100%,
right? And having high interest rates, having no cash flow, negative cash flow, and some of these things may not last forever. Rates could go up, rates could come down. So you could get to a better place where psychologically it's a lot easier to hold property, but kind of holding it through this time is going to mean whether or not you get that long-term return, which is what we're all waiting for. Right?
Yeah, absolutely. I think we've seen a lot of different scenarios of different investors over the last 2 years and how people have been able to handle this wave.
Yeah.
Right. And then some people who, let's say, grew sustainably during this time, maybe didn't use a lot of leverage to keep growing, and they're able to weather this wave. They bought a property 2 years ago in the peak of the market, but they're planning on holding it for 20 years. And they bought it with a regular down payment and they're doing everything. Yeah, this isn't a great time for them. Their net worth has gone down, but they're able to hold this property. It's not affecting them. And in 20 years, you're not going to worry about this when you let that happen, right? Whereas if you're, say, somebody who borrowed the down payment, borrowed the renovation funds, bought at the peak of the market, can't sustain yourself, now have to sell one or more assets just so you keep your head above water.
Yeah.
In 20 years, you're going to look back at this and be like, yeah, that was the worst thing class. Yeah. Right. And so I think the staying power, as you and I have talked about before, is huge. Right. And so if this move can increase your staying power, then I think it's a good move for you.
Yeah.
Right. And if this move doesn't really affect your staying power at all, then maybe look at what's, from a monthly perspective where you're making more money with it. But staying power is something that I think is very, very important. And I think a lot more investors are realizing that when we're going through a downturn, because those that are going to weather the storm and they're not worried about it, or it's maybe the most comfortable situation, but they're going to be able to weather the storm.
Yeah.
They're going to do just fine. Right. And I think that's when you're buying real estate for the long term, you need to make sure that you can hold it for the long term. Because real estate's going to have its ups and downs, but you just make that big zoom out and you're going to do okay generally, right? So
that's great advice. And I think that it is very good to combine not all financial decisions are just financial, not all investing decisions are just bulk investment.
I would say almost none. First of all, that's my view. Is I feel like there's such a psychological kind of investing, because whether you want to realize it or not, there are emotions, like there are emotions involved in investing. I remember when I started working with a lot with investors, people are, we talk to other realtors who deal all with regular end users, like, oh, it must be so different, like dealing with people who are like emotionally attached to properties. And I'm like, they may not be emotionally attached to that address specifically, like you may be if you're a regular end user, but there is a crap ton of emotion related to that decision. Because guess what? They're emotionally attached to their money. They might not be emotionally attached to the property, but they're emotionally attached to their money. And so there is a lot of emotions that are involved in any investment decision, and being self-aware of that and how those decisions are going to affect your emotions will help you manage for the long term, right? And I think just kind of like one other point on that is some people who are selling investment properties right now, there's generally I think two types of people. So there's the people who have to sell right now, and they're not happy about selling. They're probably not, there's lots of things are going down with them that's not great. But then you have other people who have been in the market for, they bought their property in 1986, and they bought it for $30,000 or $100,000 or whatever it may be, and their plan was always to retire in 2020. And market maybe down 100,000. But they don't care, because they made their money in real estate. They stayed the course. They held it for the long term. And this downturn that's going on right now isn't affecting them because they put themselves in a place where they can have a skin tank, right? And that's the guy I want to be. I don't want to be the guy who's having to sell because he has to sell, and not because he wants to sell.
Like, how much do you care about high interest rates when your mortgage is on 20 grand?
You probably don't care. You really don't care. Because your cash flow is being affected so low. Right? So it's an interesting thing. But I think for us, it came down to ultimately, it's going to increase our staying power, which is good. And it's going to increase the money in the bank account month over month. So it really seemed like a no-brainer from where we are, with the very, very small chance that I think there is an opportunity cost. The other two reasons way over that.
So if someone thought they were in your same situation where this made sense for them, how would they go about it?
For sure. So basically, whoever your lender is, give them a call the branch, and basically say, hey, I'm looking into locking into a fixed rate. What kind of terms can you give me? They're going to give you some terms. Go back to them. Say, hey, I really like these terms. Anyway, you can kind of do better. Maybe even reach out to another bank and kind of get a rate sheet from them saying, maybe you're with Scotia. Say, hey, TD's offering me 0.5% more than you guys are. Can you guys match this, or can you do something like that? And you talk it over with who's ever a decision maker involved, and it makes sense, and go for it. And obviously, if you're interested in even just having a bit of a conversation about it, feel free to contact either one of us. We'd be happy to just provide some advice.
Yeah, absolutely. So
awesome.
Yeah, no, a lot of great advice, and I think there's probably a lot of people in this situation, because back in 21, I remember seeing a stat close to half of all new mortgages were variable rate mortgage.
It seemed like there was a really big push back around in 21 for that.
Because I think a lot of people saw rates in 2019 were in the floors, and then the people who locked in saw the variable rate holders go from 4 to 1.5. And they're like, shoot, I should have got variable. So anyone who had a mortgage renewal or refinance, there's no way I'll go to a fixed when variable rates are so cheap. That's the worst.
And there was even at that point in time, I think the property that I'm currently talking about, I think when we locked down, when we got the it was 1.3.
Yeah.
1 point.
And what was the fixed back then?
It was probably mid twos or something like that. Right. So it was more than a percent. It was more than a percent difference. And I remember at that time, you're talking to people, and it's it's not going to go up by that percent. I mean, the Prime Minister of Canada said it wasn't going to go up by more than a percent of that.
Yeah.
And so we, believe that, listen to that, and
I have a client that I was just talking to the other day. His primary residence is coming up for renewal next year.
Okay.
But he's been on a 1.7% rate this whole time. And the crazy part is, when your rates are that low, 70% of your principal or your payment is to principal, right? So there's a big lost opportunity of all the pay down you could have had for all these years, right? And I've been the same boat as you. All the mortgages I had were variable. The idea of a fixed wasn't even on the radar back then, because my mindset was I wanted to refinance, I think, buy more. Mm-hmm. And that's probably a lot of investors, right? It wasn't about fixed or variable. It was more I just want to grow. So let me not lock myself in. And
Yep.
unfortunately, things like this happen.
But you gotta be able to kind of deal with it, and yeah, doing a move like this, we kind of help you weather the storm.
Yep.
Then maybe it would be worth looking into. So
Awesome.